Okay, let's dive right into this explainer. Today, we're unpacking a really incredible financial turnaround in the automotive sector. We are looking at the latest data from Motorcar Parts of America, and we're going to track their journey from posting some pretty heavy losses all the way to achieving this wildly accelerated profitability for fiscal 2026. Now, you might be wondering, who exactly are they? For those needing a quick refresher, Motorcar Parts of America, or MPAA, is a major player in the auto aftermarket. They manufacture, remanufacture, and distribute basically everything. We're talking alternators, starters, brake pads, rotors, you name it. And their fiscal 2026 year-end report, well, it's pretty much a textbook example of corporate resilience. So here is our roadmap for today. We'll quickly cover the Q4 earnings surge, driving the full year, unpacking the complexities, capitalizing on competitors, and finally, the road to $900 million. Let's start right off with Section 1. The Q4 earnings surge. The immediate top-line figure reveals a nearly 10% jump, 9.9% to be exact, in net sales. That brings them to $212.3 million for just the fourth quarter alone. This proves some serious end-of-year momentum. And what's super interesting here is that this number actually includes about $19.9 million tied to realigning inventory at customer distribution centers, which really just shows how deeply integrated they are into their customer supply chains. But the bottom line is what tells the real story. Back in Q4 of 2025, they were sitting on a $722,000 net loss. Ouch, right? Fast forward just one single year to Q4 2026, and they swung to a staggering $9.7 million net profit. I mean, that is a remarkably swift, massive shift in profitability in a really short window of time. Moving out to the big picture with Section 2, driving the full year. Take a second to really absorb the sheer scale of this change. For the entire fiscal year of 2025, NPAA was stuck in a painful $19.5 million hole. That is a tough place for absolutely any business to operate. But in fiscal 2026, they completely reversed course. They posted a $12.4 million net income. It's basically the corporate equivalent of pulling a handbrake U-turn at top speed. We are talking about a positive swing of over $31 million year over year. So, what exactly fueled this massive recovery? Well, operating income reached a highly impressive $65.8 million, which is way up from just $39.9 million the year prior. This whole surge was driven by some serious operating efficiencies and increasing the utilization of their brake-related capacity. Basically, they got significantly better at producing exactly what customers needed, supporting margin growth right across the board. All right, let's get into the weeds a bit with Section 3. Unpacking the complexities. To understand how this works beneath the surface, we really need to look at non-GAAP EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. I know, it's a mouthful, but this metric essentially strips out all the non-operational and accounting-based expenses to reveal the raw, core earning power of the company. Think of it as the actual cash engine of the business. For the full year, MPA's EBITDA hit a very robust $76.4 million, completely validating the fundamental strength of their model. Diving into the hidden complexities affecting those figures, they had to absorb over $2.1 million in net tariff costs before they could even pass on price increases, plus over $3.6 million in transition and severance expenses. There was also a $6.5 million cash gain related to that massive inventory realignment we mentioned earlier. The real takeaway here? Their $12.4 million net income is actually even more impressive when you realize the sheer volume of operational headwinds they had to navigate just to secure it. Which brings us to the really fun part. Section 4, capitalizing on competitors. According to Selwyn Joffe, the chairman, president, and CEO, they definitely faced some headwinds, including a pretty hefty $30 million sales decrease from a single large customer's ordering activity. But despite that, they ended the year incredibly strong. The absolutely crucial part of his statement, though, is the pivot toward new business commitments. They aren't dwelling on the past headwinds. Their focus is locked onto a totally new horizon. So where are all these new opportunities coming from? Well, MPAA is actively seizing market share because their customers are currently taking advantage of liquidated inventory from a previous supplier. Essentially, a competitor stumbled. And while those customers are working through that cheap, liquidated stock right now, MPAA swooped in and secured the ongoing business commitments. They are perfectly positioned to absolutely dominate the supply chain as soon as that old inventory clears out. And that sets up Section 5 perfectly. The road to $900 million. Looking at their forward-looking guidance, these numbers are aggressive, to say the least. They're projecting net sales growth between 7.5 and 10.2%, estimating top-line sales of $780 to $800 million. Operating income is expected to climb somewhere between $86 and $91 million, with projected EBITDA heading up to $100 million. It's an incredibly clear runway for growth, especially since the company expects those new business commitments to really ramp up in the second half of the fiscal year. But here is the absolute kicker, the thing that's truly wild about the scale of their ambition. The company expects to add more than $100 million of additional annualized net sales by the end of fiscal 2027. And get this, because the exact timing of when those new customers will burn through that old liquidated stock is still a bit uncertain, this massive $100 million boost isn't even fully factored into the base guidance we literally just talked about. It is purely additive. You add it all up, their base expectations alongside those newly secured business commitments, and the company expects their annualized run rate sales to cross a staggering $900 million threshold by the close of fiscal 2027. They aren't just recovering from a bad year anymore, they are dramatically accelerating their scale in the auto aftermarket. Which brings us to our final thought for today. With these incredibly aggressive growth targets, vastly improved profitability, and their swift action to capitalize on a competitor's missteps, has Motorcar Parts of America quietly become an overlooked heavyweight in the market? Seriously, consider how this one-year turnaround completely sets the stage for potential long-term industry dominance. It's going to be absolutely fascinating to keep a close eye on how these commitments actually materialize in their next earnings report. Thanks for joining me on this explainer today, and as always, keep learning.